Today we're exploring premium financing, a life insurance funding strategy that, when properly structured, can be a meaningful tool for qualifying high net worth individuals, business owners, and corporations with significant life insurance needs. Premium financing may seem complex at first, and it is, which is exactly why we want to walk through it clearly, including both how it works and where the real risks lie. At its core, premium financing is a method of funding life insurance premiums using a loan from an independent third-party lender rather than out-of-pocket capital. This approach is most commonly used with policies that carry both a death benefit and a cash value component, such as indexed universal life or IUL and whole life insurance. The primary objective is to preserve personal or business liquidity rather than committing substantial capital to annual premium payments. Who is this strategy designed for? Premium financing is typically appropriate for high net worth individuals, business owners, or corporate entities that need significant life insurance coverage and want to keep capital available for other purposes. It is not a one-size-fits-all strategy, and suitability depends heavily on individual financial circumstances, health underwriting, and the ability to manage the loan over time. Let's walk through the key components. The loan amount is based on the insurance premium being financed. Interest rates, which may be fixed or variable, directly affect the overall cost of the arrangement and must be carefully evaluated. Collateral is required by the lender to secure the loan. In many cases, the policy's cash value can serve as part of that collateral, though additional assets may also be required. Repayment terms vary. Some arrangements involve repaying the loan during the insured's lifetime, while others are structured so the loan is settled through the policy's death benefit. Understanding each of these components is essential to managing the arrangement responsibly. Now let's address the risks directly because they are real and must be understood before proceeding. Interest rate risk is one of the most significant. If rates rise, your borrowing costs increase, which can affect whether the strategy remains sustainable as originally illustrated. Policy performance risk is equally important. Illustrated values on any life insurance policy are non-guaranteed projections based on current assumptions, and if actual performance falls short, the borrower may need to contribute additional funds or collateral to keep the policy in force. Collateral risk is also present. If the value of collateral assets declines, lenders may require additional collateral to be posted. And lapse risk carries a consequence many clients don't anticipate. If the policy lapses while a loan is outstanding, the forgiven loan balance may be treated as taxable income, which is why tax advisor involvement is essential from the beginning. To illustrate how this might apply in practice, and these are hypothetical examples only, individual results will vary and are not guaranteed. Consider a business owner who needs a substantial life insurance policy for estate planning purposes. Rather than liquidating assets to cover premiums, they work with a lender to finance those premiums, allowing their existing capital to remain available for other business purposes. Or consider a high net worth individual who wants to put a significant death benefit in place while keeping liquidity intact for other financial planning objectives. In both cases, the arrangement requires careful structuring, experienced advisors, and ongoing management. The potential advantages of premium financing, when the strategy is right for the client and properly structured, include the ability to fund a larger life insurance policy while preserving liquidity, potential tax advantage access to cash value depending on policy structure and individual circumstances, and estate planning efficiency for transferring wealth. These benefits, however, are entirely dependent on how well the arrangement is constructed and managed, and on working with advisors who understand both the insurance and the lending components. In conclusion, premium financing is a sophisticated life insurance strategy that requires a thorough understanding of its structure, its costs, and its risks. It is not suitable for everyone. Working with knowledgeable, licensed professionals, including your insurance producer, lender, tax advisor, and legal counsel, is not optional with this strategy. It is essential if you are considering a large life insurance policy and want to understand whether premium financing may be appropriate for your situation. We encourage you to start that conversation with your advisors.